Hi everyone, it's Brian with Valuestockspro. Wanted to take a few minutes to go through in detail one of the reports in the undervalued stock reports section. I'm going to use IBM as an example. We'll go through it in detail to show you all the different valuation models and assumptions that are in there. So the report shows that IBM closed at $148.89 on November 14th. Based on the analysis, we're finding it to be undervalued. All of the reports that are in this section are all from undervalued stocks. A little bit of background on the company. Then we start to get into the actual valuation information. So our analyst consensus is at $156 a share. Our comps are actually at $187 a share, and our adjusted book value is at $190. So we're seeing some very strong numbers through there. The company, we actually show its valuation on the basis of cash flow, comparables, and assets, and in this case it's showing undervalued on all of those bases. We'll go into this in a little bit. So we show 5 different valuation models plus analyst consensus for the company and the valuation calculations that we're getting for those 5 different models. The discounted cash flow model is an actual cash flow projection discounted back to the present time to come up with the valuation. So basically we're taking the cash flow that the company is generating, projecting it forward, and then discounting it back on the basis of their cost of capital. We subtract the debt that's outstanding, and then we divide by the number of shares outstanding to come up with a valuation. We actually run sensitivity analysis around that as well too, so for any particular company you can see how sensitive it is to key things like cost of capital, growth rate, tax rate, its cash flow projections, its capex, and long-term debt. You can see generally these ones, the cash flow, capex, and long-term debt, there's a little change but not as much. It's much more sensitive generally to the cost of capital. If it changes by 1%, for example, you can see the swings that occur there. Or the growth rates, the same is true, the swings that occur there. So companies are very sensitive generally to these 2 pieces of information, their cost of capital or their terminal growth rate. Cost of capital is the implied cost of the next dollar that they would need to raise either through debt or equity. And the terminal growth rate is the long-term projected growth rate for the company. If we go into the comparables model, what we do is we actually select the company's current statistics against a number of ratios. So we look at the price to earnings, price to book, price to sales, price to cash flow, and EV to EBITDA ratios. We get those from comparable companies, and when we ran IBM, we only had one comparable company come up, Cognizant Technologies. So we took the numbers from Cognizant and run them against the current earnings per share, book value per share, etc. for IBM to come up with the valuation numbers. So you can see how that runs. We have adjustment factors in here as well too, and what these are is how has this company compared to its industry over the last 10 years, and then we make adjustments. So if a company historically has a higher price to earnings ratio than its industry, we can make the adjustments in here to right size these numbers. You can see some information in the charts here, how the company compares to the other companies that it's been valued against as well. Multiples is an approach we use to value the company against itself. And generally what this tells us is whether we think the company is under or overvalued compared to itself over the last 5 years. So we see that if we go back up to the price at the top here, IBM is at $149 approximately. And on a multiple basis, it's at $160. So it's saying that IBM is still actually cheap compared to itself over the last 5 years. And we use the same methodology that you see above, where we're using price to earnings, price to book ratios, and so forth, and we're using the average values for the company against its current ratios to come up with current pricing. And you can see how they're varying across the different ratios, the values that we're getting. There's fair consistency with the exception of price to book ratio, for example. Adjusted book, what we do is we actually take the balance sheet, calculate the book value, and then apply the average price to book ratio over the last 10 years against that. So based on a book value of $19 a share and a price to book of 9.9, we're coming up with a $190 value for the company based on its average price to book over the last 10 years. Analyst data, You see the information that's available in the analyst data here, so the earnings per share estimates number of analysts, revenue estimates, cash flow, EBITDA, tax rates, growth rates, etc. All of this information was also used in the discounted cash flow model above to help us generate the projections that we needed so that we could do the cash flow projections. So based on the analyst data, we see the consensus data here at 156.13 from the 8 analysts in the database for 2018 consensus. We also have some recommendation information, whether it's buy, hold, or sell based on the analysts. So you can see from the 11 analysts, the consensus is hold in this case. Then finally, a bit of information, current trading on the company, historic price chart, bit of information on the company, and then some more explanation of the different valuation models that are used. So what this does is this gives you a basis of fundamental information to look at the company with. If you want to get into more detail, you can use the StockCalc website to come up with the valuations, run the companies through there, and start running what-if scenarios against those. What if we use different comparable companies? What if we use different growth rate estimates or cost of capital estimates? That information's all available there. But this report gives you a nice summary around those different models to show you how we're valuing the companies that you're seeing here. So thanks for taking a few minutes to take a look at this, and we hope you find Valuestockspro of good use for you.